Walgreens Boots Alliance, stock ticker WBA, is now trading right at its 52-week low, which gives them a starting dividend yield sitting very high at 7.23%, which I know gets a lot of dividend investors excited. Now, the question we need to answer is it trading at $26.54 a good value to buy in at? Now, we can see over the past year, it's down around 30.6%, and year to date, down 28.64%, so it's definitely missed out on the 2023 bull market. Now, let's go ahead and jump into some of the dividend metrics first to get a quick overview of this company. Now we can see they have a very good history of increasing their dividend payouts over time. Starting in 2000, it looks like they were paying out around 3 cents per share in dividends. Jump forward over 20 years later, it's now sitting at around 48 cents per share every single quarter. Now, since they have increased dividends for a pretty long time, we can see the dividend growth rate has slowed down quite a bit over the past decade. That 3-year dividend growth rate sitting at 1.43%. Now keep in mind, it's great that they've been increasing dividends, but anytime you see a really low dividend growth rate, if it's below the rate of inflation, that company is technically paying out less in dividends every single year. But we can see the 5-year dividend growth rate sitting at 3.2% and the 10-year is decent, sitting at 5.35%, but those dividend growth rates have definitely been slowing, which is a little bit of a concern. Now let's go ahead and jump into that dividend safety. If we scroll down right here, we can see the dividend payout ratio for the non-GAAP trailing 12 months sitting at 46.6%, and the cash flow payout ratio, this is what I like to look at the most, sitting just barely over 50%. Now the problem a lot of people have with this company is the slowing growth. If we jump over to the financial statements and look at the income statement, you can see the revenues right here. Revenue growth has really started to slow by quite a bit over the past couple of years. We didn't really see any growth from 2021 to 2022, and there's not a lot of projected growth into 2023 as well. Not to mention, if we look at those gross profit margins, it really hasn't done anything for almost the past 6, 7, or 8 years. So what we need to do now is jump over to my stock valuation spreadsheet to see if we can find the intrinsic value of Walgreens and decide if it's a stock we should consider buying or selling. And we'll be looking at a few different valuation models for Walgreens, and like always, if you'd like to be able to download this spreadsheet and join a community of dividend investors, then you can head over to my Patreon page at the link in the description. Let's go ahead and come up here and plug in the stock ticker WBA and hit enter, and you can see all of this data will automatically fill in. Now, like we already talked about, really nice starting dividend yield. We touched on the payout ratio just a little bit. That cash flow payout ratio was sitting closer to around 50%. Analysts currently have a target price of around $33.53, institutional ownership around 59.8%, so really not that high, but they do have a beta of just 0.68, which if you're looking for low volatility, Walgreens does appear to have that as of right now. Now, the first valuation model we will be looking at is Graham's valuation. I'll go ahead and zoom in, and you can see the formula Benjamin Graham lays out for us to calculate intrinsic value. Now, the first thing we need is our earnings per share, and we can see on Seeking Alpha, which by the way, you can get a really nice deal on at my link in the description, but they're projecting the forward-looking earnings per share sitting right at 4. So we plug that into our valuation, and then we apply our growth rate projection. And like I've already mentioned, this company has very low growth rate projections, so I'm sticking in line with analysts going with 1.5. We then multiply that by 4.4, which is the average yield on AAA corporate bonds, and divide by Y, which is the current yield on AAA corporate bonds. And at the time of this video, it is sitting very, very high, pretty much the highest it's been within the past year, sitting at around 5.11, and that will drive down this valuation by quite a bit. But you can see when we plug all this in, we come to an intrinsic value of $29.28 per share. Now, the next valuation model we're going to look at is the discounted cash flow analysis, and I actually have quite a bit I want to touch on with the discounted cash flow. You can see I've added a couple of things here to talk about here in just a little bit, but let's go ahead and go through the DCF model. Now, what a discounted cash flow analysis does is it values a company based on how much free cash flow they're going to produce in the future. So what I've done is I plugged in the historical free cash flow for this company over the past few years, so we can see our year-over-year free cash flow growth rates. Now, one of the things you will notice is they currently have a negative average growth rate over the past few years. And again, we're projecting very slow growth for the future of this company, so I am projecting a growth rate of just 0.5%. That's actually slightly higher than what analysts have projected, so I do think it's possible that we could even see 0.25% growth rate or really even 0% growth. But I am projecting 0.5% growth to the future free cash flows of the company, took the present value of all those future free cash flows and added them together, added the company's cash and cash equivalents, and subtracted out the total debt. After I took out the total debt, we get our equity value, divide by shares outstanding outstanding, and we come to a discounted cash flow price per share of $44.31. So it's actually a decent bit higher than the current trading price for the company. Now, I want to talk about where I do have concerns with some of the things that I just touched on, which is the cash and cash equivalents and total debt. Something I want to talk about more on this channel moving forward is financial ratios, and here's two that we're looking at right here that I think are extremely important to understand if you're analyzing stocks. And the first one I want to touch on is what's known as the current ratio. I'll zoom in just a little bit so we can see it closer. But all the current ratio is taking the company's current assets and dividing it by the current liabilities. And you can see our current ratio is sitting at 0.63. Now, what does that mean? Well, the current ratio is a liquidity ratio that measures a company's ability to pay short-term obligations or those due within 1 year. So ideally, we'd want to see a current ratio of at least 1 because that means the company could currently cover all of its short-term obligations with its current assets. Ideally, we'd like to see it even a little bit higher. Typically around 1.2 or above would be considered healthy. So a current ratio of just 0.63 for Walgreens is actually a pretty big red flag, and I think it's a huge concern with a lot of people, and it does actually make me have some concerns with the dividend sustainability. Now, the other ratio that I do want to look at is the long-term debt divided by total assets. This is essentially a solvency ratio, and it's very similar to what we just looked at, but it's a little bit more long-term. You can see we're taking the long-term debt and dividing by the total assets. And our solvency ratio actually looks pretty healthy in this scenario because the debt is on top dividing by the total assets. So this is a pretty healthy number overall. I think long-term the company looks decent from this scenario. The huge concern for me is will it be able to cover all of those current liabilities? But let's go ahead and keep moving forward. The next valuation model I typically look at is the multiples valuation, but I really feel like we don't have a lot of great comparables other than CVS for Walgreens. And I do like to have more than one comparable, so I'm not using it in this scenario. So that means that the last valuation model we'll look at is the dividend discount model. I'll zoom out just a little bit, but basically what we're doing is we're valuing a company based on how much they pay out in dividends and how much that dividend is increasing over time. So I plugged in the company's quarterly dividend payouts over the last few years so we can see how much they pay out each year and those year-over-year dividend growth rates. And like we already talked about, it is starting to slow down. We saw around 4% dividend growth, then 2.19, 2.14, and the most recent dividend increase was very small, under 1%. So that's an average growth rate of around 2.21%, but it's definitely been slowing down. So I'm projecting a dividend growth rate of around 1.25% moving forward with a discount rate of 8.5%, and that gives us a dividend discount model price per share of $26.81. And like I mentioned earlier, anytime you have a dividend growth rate that's really low, if it's below the rate of inflation, that essentially means the company is paying out less every single year in dividends. So to me, that is a little bit of a red flag. So now we need to jump over to our output tab where we can see the three valuation models that we used. We have Grams at 29.28, DCF at 44.31, and dividend discount model at 26.81. And when we average all three of these together, we come to an intrinsic value of $33.47. Now the current trading price is sitting at around $26.54. So with a 10% margin of safety, our acceptable buy price is around $30.12. With a 20% margin of safety, our acceptable buy price is right at that current trading price, sitting at $26.77. So it does look like it's within our buy range. Now here's the thing, just because a company has an intrinsic value that is higher than its current trading price doesn't necessarily make it a company that you should add to your portfolio. You have to keep in mind what is the end goal for your portfolio, and for me, the end goal is to one day be able to live off of dividend income. So that means the companies that I look at need to have a decent dividend growth rate and potential for capital appreciation. And I really don't think Walgreens has the ability to do either of those things right now with the current state of their business. So even if we do see Walgreens revert back to its intrinsic value in the near term, there's such little growth moving forward, I do think we do need to think in terms of opportunity costs. There's likely much better opportunities long term in the market. So for me, I don't plan on adding any Walgreens stock, even though it does look like its intrinsic value is a little bit above the current price, but go ahead and let me know what you think in the comments down below. If you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. But with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.